Welcome to a brand new show of Markets Tomorrow. I'm Nikunj Dalmia. Earnings hit market had very little to look forward to on Thursday. Although Jan inflation numbers raised hopes that WPI inflation will go down in fiscal 2013, markets ignored that cue and markets focused on poor set of numbers from State Bank of India and Tata Motors. The problem area once again was the mid-cap space, which remained under intense pressure. High beta stocks were smashed again, and just about everything from the mid-cap real estate space was on the butcher block once again. So why exactly are mid-cap and small-cap stocks underperforming and they are getting smashed out of shape? We'll discuss that for you on this edition of Markets Tomorrow with the help of Christy Fong. She represents Aberdeen Asset Management, Devin Choksi, Managing Director of KR Choksi Securities, and to give us a better understanding of how market technicals are shaping up, Deepak Moni will join us live from Pune. Gentlemen and the lady, good evening to all of you. Thank you for joining us. Deepak, first let's try and understand the market technical and the technical setup.
If you look at the Nifty, things don't look particularly negative. It's come down just barely 4 or 5% from the 6100 levels it had reached not so long ago, 2 weeks ago. But if the small cap index tells another story, this has fallen. If you take the BSE small cap index, that's come down from 7700 continuously, no respite, over 1000 points. So that's a 14-15% drop. It's below the 200-day moving average. I think the best explanation for this is that while this rally from the middle of May took place for the market as a whole, we had small caps and other stocks of a slightly more speculative nature joined the bull run a little too, let's say, vigorously, and they are being kind of found out now and punished pretty severely. But there is demand for some of the heavyweights, and that is reflecting in the Nifty, which looks like a very ordinary sort of correction right now, nothing to be alarmed about.
Devin, if I map the price action and the volume action, large cap stocks have corrected, but the price damage has not been extraordinary. But the minute I focus on mid and small cap stocks, they've been smashed out of shape. Just about every high beta stock is on the butcher block. Why has the opinion changed? Even though the news flow is strong and supportive, it appears to me that the local crowd is suddenly not interested in buying Indian equities.
Yes, Nikunj, I think the few things which probably we have noticed while discussing with customers, particularly institution segment of customers, at the higher levels they have been facing the redemption pressure, as a result of which I think they are forced to liquidate part of their portfolios. And in some of the mid-cap stocks, I think where they have started fetching the price, they have started selling the stocks out into the market. And that explains probably the behavior of some of the mid-cap stocks over the last 10 to 15 days, wherein they have basically, I think, got smashed out and the valuations are going quite low at this point of time. Vis-a-vis that, against which the buying is absent completely. The big brother LIC is certainly, I think, absent on buying side, largely as I see it. Whereas I think the other domestic institutions, including mutual funds, they are also absent on buying side. So to a greater extent, I think it explains why there is an amount of acute pressure happening on the selling side, because the buying is completely absent. Even the traders take the advantage out of it. And the victim obviously is the mid caps, I think, where people are taking exit in a very sharp manner, I think, in this point of time. Many of the mid-cap companies, having said this, many of the mid-cap companies, I believe, are becoming very attractive on the valuation front, and that could be an opportunity for those, I think, who believe that some of the business model has a sustainability and a growth prospects going forward. So I think one will have to look at the stock picking within this kind of a rough environment to get the gains out of it over a subsequent rally, and then when it happens in due course of time.
Christy Fong, how would you characterize the broader and the big picture? At the current juncture, how would you map the risk-reward ratio for Indian markets?
The risk-reward equation. Well, I guess, there's been a lot of expectations, or rather hope, that, under the current finance minister, who has announced quite a lot of reforms, that, these things will actually be put through, which will benefit the economy. There's a lot of boosting of investor confidence at the moment, so that's been reflected in the market performance. So I suppose it's really a matter of the country delivering what it said it would do. Yeah, but I guess from our perspective, we still look at India as a very good attractive long-term growth story. Obviously one that will have hiccups along the way. So, with the market run-up, valuations perhaps not as cheap as they were about 12 months back. But once, if we see firm improvement in the fundamentals, I think that will probably be justified.
Christy, Aberdeen, as the house is extremely bullish on financials, and within the financial sector, your key positions are HDFC Bank, ICICI Bank and IndusInd Bank. So after the recent run-up, why exactly are you so bullish on private banks?
We still see, I guess the way we look at financials is really the easiest and the best way to get exposure to the domestic economy. Just given how long-term we are and we focus a lot on quality of companies and the management, the private sector banks have been demonstrated very, very strong underwriting discipline. Asset quality is a lot stronger than what you see in the public sector banks. And they're still enjoying very strong, decent growth from lending to whether it's individuals or SMEs. So for that reason, we're still quite positive on these banks, just because again, very good way to get exposure to the domestic economy.
Devin, two large cap stocks which were under intense pressure today: A, Siemens; B, Wipro. The news flow here is that come 1st of March, both Wipro and Siemens will no longer be part of the Nifty 50. Are you a bit surprised with that announcement?
Yes, Nikunj, I think it comes as a shocker actually. I think for the size of companies, Siemens and Wipro, if they get taxed out of the, mainline indices, I think it would put you off, because as we all know, I think most of the overseas funds, basically they like to put across their money through ETF, and in which I think they would have the benchmark in form of the Nifty. In such situation, I think the weight allocation, when it changes, the automatic victims are the ones who are getting X'd out, and that is where I think Siemens and Wipro are becoming victimized in this kind of a situation. Honestly, I'm disappointed and at the same time surprised, because fundamentally Siemens should be performing far better going forward, and I think company getting out of the mainline indices would go out of favor from the investor's mind, and that's where I'm a little bit more disappointed as well.
Deepak, how are things technically shaping up for Wipro and Siemens?
Well, even before today's action, the two stocks were completely different from each other. Siemens had already made a one-year low 2 weeks ago, so investors were getting out of it anyhow. And this is, with today's fall, which is nearly 5%, that decline is accelerating further. This has been traditionally, if you look back 5-10 years, a fairly defensive stock. So this kind of sell-off might just lead to a bottom, but as I said, the key word here is might just. Wipro, on the other hand, that had been pretty strong until now, and today's move does bring it down a little bit, but it might come out of it. I think if you look at the level of 395, actually just a bit below it, 393 or 394. This is, I wouldn't say it's going to get support there, but that's a level to look for, because below that it goes straight to a 2-month low, and that would tend to suggest that whatever was driving the stock up until yesterday, those factors have been overridden by the decline coming in from the dropping from the index.
Devin, just when we thought that State Bank of India had turned the corner, they've come out with another horrible set of numbers. NIMs are under pressure, NPAs have expanded, and the management commentary, at least for FY14, is not looking all that rosy.
Yeah, Nikunj, I think it's certainly suggesting that the times are definitely, not helping this kind of a company to come out of the situation. I do not know about FY13-14. My personal take is that I think with the fall in the interest rate, more likely after that fall in the inflation, which could possibly offset part of provisioning that the bank has done in coming quarters. And I believe says that I think the treasury gains, when they start coming into the books, probably I think it would offset to a certain extent the provisionings out there. At the same time, I think in this particular quarter, having provided for maximum amount of provisions, probably, I would think the rate of providing for the provisions, I think, has started coming down. If in subsequent quarters, I think if the provisions are coming down, then probably I think bottom line may probably look up for the banks. But the key issue remains the credit growth, and the credit growth would probably largely be dependent on how the government initiates actions on clearing some of the infrastructure projects, where I think the growth will take place. At the same time, I think the provisioning threat will come down. These two issues would be of keen interest to watch out for, and that's where I think one would like to look at banks like SBI, how they position themselves in that kind of a situation, and government start taking corrective actions on the infrastructure side.
Devin Chokshi, what do you make of Tata Motor numbers? Way below estimates.
Yes, Nikunj, I think while going through the numbers and without having much of an explanation available from the management side, two cost areas I think which are distinctly I think shown up, and that is basically contributing to higher sum by about 2400 to 2500 crores vis-a-vis the same period last quarter, and that includes the staff cost and other expenses cost. I think they're shot up significantly by 2400 to 2500 crores over last year period, and that needs to be explained. Even sequentially also there is a growth, a significant amount of growth in this particular area. Having understood the domestic market portfolio which is in trouble, and having understood that I think this portfolio is certainly not heading well as far as the production and the sales are concerned, I think the JLR portfolio was expected to perform well, but these two cost factors I think which definitely demands a good amount of understanding and explanation from management side, which has come to me personally as well. I think are a bit surprised I think how exactly these numbers have come up so significantly.
So what could be the next port of call for Tata Motors? Today it has cracked below 300. Do you see Tata Motors going below 275 in quick hurry?
A lot would depend, Nikunj, on how exactly I think these cost items are explained. If there are certain items which are within this, I think there are certain expenditure which are one-off kind of expenditure, then market would try to normalize this particular expenditure and then see the result accordingly, which I am waiting for the detail, I think, which will appear in the con call today evening. So I think once that details are out, I think probably one could take a call. But as of now, I think probably if the market goes below 270, then it could possibly go down further. That is where I think I'm a little worried about. So one will have to wait and see how exactly the clarifications comes in. Personally, I still remain very bullish on Tata Motors, and I feel that if some of these one-off item goes out and if the rate of interest comes down, the domestic market portfolio of commercial vehicle could start showing up gradually, and that's where I think my confidence is a little bit more comparatively. But we'll have to get the clarification on these items before taking a final call on buying immediately or buying with a gradual speed, I think, in the falling market.
Deepak, exactly 2 weeks ago, everything was going favorable for Tata Motors, but now nothing seems to be going their way.
It's still not the worst performing stock around. I mean, if you look at the last 5 sessions, we are still 3% up over where we were exactly a week ago. So this is an extremely volatile stock. Now, when you get a 2.5% drop like you did today, it doesn't mean all that much because it bounces back with equal vigor when it does. So I wouldn't say the long-term trend in the stock has turned down. I wouldn't say it's even threatened. The intermediate trend is also possibly up because only yesterday it was at a 3-week high. Let's see how it does tomorrow, day after. But somebody wanting a stock in the portfolio which is not so volatile in both directions, I think Mahindra is looking a little better right now.
Christy, any regrets on selling Bharti? Because the minute you sold out Bharti, which was one of your core positions for entire 2012, the stock actually bottomed out after that.
We actually still have a small position in our India country funds. So yes, a very challenging sector. Tariffs are extremely low, highly competitive, and also Bharti has been finding it quite a challenge to really meet their profit targets in Africa. But again, we like the company in the telco space, for the fact that they are the market leader. They have the operating track record. So at the moment, we do still have a small position, though we do recognize the sector risk when it comes to spectrum issues and how much they actually have to end up paying for it. And again, I think we have to wait and see for market consolidation to actually happen, and that will actually benefit Bharti.